You look at the spot price on your screen right now, hovering around $81, maybe $82, and it looks boring. It looks like a consolidation day. It looks safe. That is the most dangerous thing a market can do. Look calm while the foundation is literally being dragged out the back door. Because what we just saw, this 4.2 million ounce exit from the COMEX registered vaults, isn't trading. Trading is paper moving back and forth. Trading is noise. This is a physical raid. I don't use that word lightly. I hate the sensationalism you see in the headlines, the constant silver to the moon rhetoric that's been wrong for 5 years straight. But you have to respect the mechanics. When you strip 4 million ounces of deliverable metal from a localized exchange in 2 days, you aren't speculating on price. You are securing supply because you don't think it's going to be there next week. And that's the part that keeps nagging at me. Usually, when we see a drain like this, it's scattered. 1 million here, 500,000 there. It looks like noise. This was a clean sweep, and it follows what we saw in January. Remember that week, the 7th through the 9th? 12 million ounces vanished. People forgot about it because the price dropped. They looked at the red candle and assumed the selling meant plenty of supply. That is the trap. We are trained to look at the price to tell us the truth about supply and demand. If price is down, supply must be high, right? That's Economics 101. But the silver market hasn't operated on Economics 101. It operates on leverage, on leasing, on paper derivatives that outnumber the physical bars by 100 to 1. But you can't build a solar panel with a paper derivative. You can't plate a high-efficiency AI server interconnect with a futures contract. You need the metal. And right now, as of this morning, February 11th, the entities that actually need the metal, not the traders, the users, are panicking. They aren't waiting for the price to dip. They are taking what is nailed down. So here's the mystery I want to walk through with you. The math doesn't work anymore. We're sitting at roughly 103 million ounces in registered. That sounds like a lot until you realize how many claims exist against it. We're watching a game of musical chairs, where the music hasn't stopped yet, but someone just walked into the room and removed 20% of the chairs while everyone was dancing. If you're holding paper, you're looking at a chart that says sell. If you're looking at the vault is screaming run. I want to show you why the gap between those two realities is about to snap shut, and why this specific 4.2 million ounce withdrawal is the signal we've been waiting for since 2024. It's not about the price today, it's about the inventory that won't be there tomorrow. And that is where the narrative starts to fracture. Because if you listen to the mainstream financial press, or you read the daily summaries from the big brokerage houses, you are being told that the silver market is well supplied. You're being told that the industrial slowdown in Europe means demand is soft. They'll point to the price chart, stuck in this $80 range, and say, see, if there was a shortage, we'd be at 100, we'd be at 150. But that logic assumes the price discovery mechanism is working. It assumes that the price on the screen reflects the physical reality in the vault. And what I'm telling you, what the data from the last 48 hours is screaming, is that those two things have completely decoupled. Let's look at the inventory itself. When we talk about COMEX silver, we aren't talking about one big pile of metal. We have to be precise here. There are two categories, eligible and registered. Eligible just means the silver meets the purity standards and it's sitting in a warehouse. It's owned by someone, maybe a private investor, maybe a bank, but it is not for sale. It's just parked there. It's storage. Registered is the metal that is actually available to settle a futures contract. It is the inventory on the showroom floor. It is the liquidity. As of this morning, that number, registered silver, has collapsed to roughly 103 million ounces. Now, 103 sounds like a fortress. It sounds like plenty, but you have to contextualize that against the claims. If you look at the open interest, the number of paper contracts that exist where people have bet on the price of silver, and you compare it to the physical metal available to satisfy those bets if everyone stood for delivery, the coverage ratio is sitting at roughly 24%. Think about that. For every 4 ounces of paper silver being traded, being leveraged, being used to set the global price, there is less than 1 ounce of physical metal actually available to back it up. This is the fractional reserve banking of commodities, and usually it works fine. Usually nobody asks for the metal.
Traders want cash settlements. They don't want 5,000 ounces of silver dropped on their driveway. The system relies on confidence. It relies on the assumption that if you wanted the metal, you could get it.
But when you see a 4.2 million ounce drawdown in a single session, the largest 48-hour drain we've seen in 2026, that assumption breaks. Someone isn't playing the paper game anymore. Someone is calling the bluff. Who is it? This is where it gets interesting and frankly a little terrifying if you are short this market. It isn't the Reddit crowd. It isn't the coin shop down the street. It's industrial panic. We have spent the last 2 years talking about the green energy transition, about solar panels needing silver, and yes, that demand is massive. Despite all the talk of thrifting, using less silver per panel, the sheer volume of installations in 2025 overwhelmed the savings. But that is old news. The market priced that in. What the market did not price in, what nobody seems to be talking about on CNBC, is the AI hardware shift. You see, late in 2025, we started seeing a change in the architecture of data centers. We aren't just building servers anymore, we're building massive heat-generating, power-hungry compute clusters. The efficiency requirements for the interconnects, the tiny pathways that electricity travels through, have spiked. Copper isn't efficient enough for the new generation of AI hardware. It creates too much resistance, too much heat. So they turned to silver. Silver is the most conductive metal on Earth. It's the only thing that works at this scale. And unlike jewelry or silverware, this industrial silver is consumed. It's buried inside a server farm or pasted onto a solar cell. It doesn't come back next year. It's gone. So you have this relentless price inelastic demand from the tech sector. They need the metal, regardless of if it costs $80 or $100, colliding with a vault system that is being drained at record speed. And this next part is where it stops making sense. Demand is exploding. Supply is vanishing. Why is the price flat? Why are we sitting here at $81? The answer lies in the arbitrage, and specifically in what is happening in Shanghai. While everyone is watching the COMEX in New York, the real story is happening at the Shanghai Futures Exchange. Their inventories haven't just dipped, they have evaporated. We're looking at numbers below 350 tons. That's a 10-year low. China is effectively out of silver. But China is the manufacturing hub of the world. They make the solar panels. They assemble the electronics. They cannot function without the metal. So what do? They come here. They look at the COMEX price, which is being suppressed by paper shorting, and they say thank you very much. They buy the contracts, they stand for delivery, they take the physical bars, and they ship them east. We are witnessing a massive transfer of real wealth from west to east, facilitated by a broken pricing mechanism. The Western banks are busy suppressing the paper price to protect their short positions, and in doing so, they're putting the physical inventory on sale for the very country that needs it most. It's a subsidy. The U.S. futures market is effectively subsidizing Chinese industrial dominance by keeping silver artificially cheap while they drain the vault. And the 4.2 million ounces that left yesterday, that has all the fingerprints of an arbitrage play. It wasn't a gradual bleed, it was a bulk withdrawal. It was a clean out. This brings us to the most dangerous part of the equation, the illusion of safety. Most investors look at that 103 million ounce figure in registered and think, okay, we still have a buffer, we have 24% coverage, it's not zero. But that number is a mirage. You have to understand how the bullion banks operate. They don't just sit on piles of unencumbered metal. Much of that registered inventory is already spoken for. It's leased. It's pledged as collateral. It's part of a complex web of obligations that keeps the gears turning. When inventories are high, you can play that game. You can lease silver to a refiner who leases it to a manufacturer, and the paper trail makes it look like the metal is still in the vault. But as you get closer to the bottom of the barrel, and make no mistake, 103 million ounces is the bottom of the barrel for a market this size, the friction starts to build. You try to find a bar to deliver, and you realize the bar you thought you had is actually leased to someone else. You have to go into the open market and buy it. That is what causes a squeeze. It isn't when the vault hits zero. The vault never hits zero.
The squeeze happens when the velocity of the drain exceeds the velocity of the restocking. And right now, we are draining at a rate of millions of ounces a week, and the mines? The mines are flat. Global mine production hasn't budged in a decade. We are in a structural deficit for the 6th year in a row. So you have shrinking production, exploding industrial demand from a sector that didn't exist 3 years ago, and a vault system that is bleeding 4% of its total inventory in 48 hours. This is where most people get trapped. They look at the daily price action, up 50 cents, down 50 cents, and they think the market is in equilibrium. They think the smart money has this under control.
But if the smart money had this under control, they wouldn't be letting 4.2 million ounces walk out the door at $81. They would be defending that inventory. The fact that they can't or won't tells me that the mechanism is starting to seize up. And that brings us to the leasing market. This is the invisible plumbing that nobody talks about, but it is the single most important signal I am watching right now. Because usually, when physical metal gets tight, the cost to lease it goes up. Makes sense, right? If it's scarce, you charge more to lend it. But we are seeing something stranger than that. We are seeing a reluctance to lease at all. The banks are starting to hoard the physical. They're happy to sell you a paper contract, but try to ask them for a physical allocation for immediate delivery, and suddenly the phone calls don't get returned as quickly. Suddenly, the premiums for immediate delivery start to creep up, even while the spot price stays flat. That divergence, the spread between the paper price and the cost to actually get your hands on the metal, is the crack in the dam. I want you to really sit with that contradiction. Price is stable, inventory is crashing, paper is abundant, metal is scarce. The West is selling, the East is buying. Something has to give. You cannot violate the laws of supply and demand forever. You can suppress the beach ball under the water for a long time, but the deeper you push it, the more violent the pop is going to be when you lose your grip. And looking at this 4.2 million ounce drain, I think the grip is slipping.
But here is the catch, and this is the part that is going to make some of you angry, but you need to hear it. Just because the fundamentals are screaming shortage doesn't mean the price explodes tomorrow. In fact, the most dangerous moment is right before the break, because the entities that are short, the ones who are on the wrong side of this trade, they are not going to go down without a fight. They have deep pockets, and they have the ability to flood the paper market with sell orders, to paint the tape, to make the chart look broken, to scare you out of your position right before the delivery truck shows up empty. We're in the volatility zone now. So how does this actually break? What is the mechanic that turns a vault drain into a price explosion? It's not magic, it's a specific sequence of events that has happened before in other commodities, and it is setting up right now in silver. To understand it, you have to stop thinking like a trader and start thinking like a warehouse manager who just realized his inventory count is wrong and the trucks are already pulling up to the loading dock. And that manager doesn't panic immediately. He checks the ledger. The ledger says the metal is there, but when he walks to the aisle, the pallet is empty. This is the mechanism that most people miss because it's boring, it's accounting, but it's the accounting that blows up markets. You have to understand that the COMEX was never designed to deliver metal to industry. It was designed to hedge price risk. It's a casino where farmers and miners and bankers bet on the future price. Delivery is the exception, not the rule. The system is built on the assumption that 99% of people will just settle in cash. Here, take your profit in dollars, go buy the metal somewhere else. But somewhere else is running dry.
The core mechanism breaking down right now is the leasing market. This is technical, but stick with me because this is the engine of the suppression. In a normal market, if a bullion bank, let's call them the authorized participant, holds silver, they don't just let it sit there gathering dust. They lease it out. They lend it to a refiner or a manufacturer to earn a small yield. The refiner takes that silver, melts it down, turns it into a wire or a coin, and sells it. Here's the trick. The bank still records that silver as an asset on their books. They have a claim on it. The refiner has a liability to return it. But the physical metal, the actual atoms of silver, they're gone. They're in a solar panel on a roof in Arizona.
So you have one bar of silver that exists physically in the world, but financial claims for that bar sitting on 2 or 3 different balance sheets. This is called rehypothecation. It sounds like fraud in any other business, selling the same house to 3 people, but in commodities, it's just liquidity. It's how the wheels turn. The 4.2 million ounce drain we just saw tells me that the music has stopped for the leasing game. When you see registered inventory drop that hard, that fast, it usually means the owners of the metal are calling in their leases. They're saying, I don't want the yield anymore, I want the bar. Why? Because they don't trust the counterparty to give it back later.
If you're a bank and you leased silver to a factory in 2024, and now that factory is desperate for metal because China is buying everything, you start to worry. You worry that if you don't get your metal back now, you're never getting it back. So you recall the lease. The borrower has to scramble to buy physical metal in the open market to pay you back. That creates a scramble. That creates a drain. And here's the signal that everyone is ignoring while they stare at the spot price. Look at the backwardation. I know, it's a terrible word. It sounds like gibberish, but it is the most violent signal in a commodity market. Normally, silver for delivery next year should cost more than silver for delivery today. You have to pay for storage, for insurance, for the time value of money. That's a healthy market. It's called contango. But right now, in certain pockets of the wholesale market, we are seeing the opposite. We are seeing immediate delivery costing more than future delivery. Think about what that means. It means the market is saying, I don't care about storage costs. I don't care about interest rates. I need the metal right now, and I will pay a premium to have it in my hand today rather than a promise for next month. That is panic. That is the warehouse manager realizing the truck is at the dock and the shelf is empty. When backwardation sets in, the spot price, the $81 you see on the ticker, becomes irrelevant. That price is for a paper contract. If you want the metal, you pay the spot price plus a premium, and that premium is the real price. We are seeing a bifurcation, a split reality. There is the paper price that the algorithms trade, and there is the physical price that industry pays, and the gap is widening.
The 4.2 million ounce drain is the physical market decoupling from the paper market. It is the sound of the real price tearing away from the fake price. Now, I want to pause here. I want to be completely honest with you, because if I sit here and tell you this is a guaranteed moonshot, that silver is going to $150 by Christmas, I am doing exactly what the hype channels do. I'm selling you certainty in a world that doesn't have any. There is a scenario where I'm wrong, and it's important you understand it, because it's the only thing that keeps me up at night regarding this trade. Here is what would invalidate this entire thesis: the hidden hoard. We know about the registered inventory. We see the numbers every day, but there is a massive amount of silver sitting in illegible vaults, hundreds of millions of ounces, that isn't technically for sale, but could be. There's also the London Bullion Market Association in the UK. They claim to hold over 800 million ounces. The bear case, the reason silver might not explode, is that as the price ticks up, all that hidden silver floods the market. Maybe JP Morgan or a sovereign wealth fund has been quietly accumulating a massive strategic reserve for 10 years, just waiting for silver to hit $85 so they can dump it. If that happens, if suddenly 50 million ounces of illegible silver gets transferred to registered next week, then this squeeze is over. The shortage is fake. The panic is misplaced. We would see the price crash back down to $60, and everyone who bought the breakout would get slaughtered. That is the risk. The risk is that the supply is opaque. We can't see inside the private vaults. We have to infer what's there by how the market acts.
But, and this is a massive but, if that hidden hoard existed and was liquid, why haven't we seen it? We have been in a deficit for 6 years. We've seen prices spike to $120 in January. If there was a secret stockpile waiting to be sold, why didn't they sell it then? Why are they letting the COMEX bleed out? The fact that the hidden silver didn't show up when the price was screaming high suggests that maybe it's not as available as they say. Maybe it's already leased. Maybe it's owned by long-term holders like family offices or endowments who have no intention of selling no matter the price. If the eligible silver is sticky, if it doesn't move, then the registered number is the only number that matters, and that number is dying. So we are left with a binary setup. This isn't a wait-and-see market anymore, it's a fork in the road. Path 1, the deflationary bust. The hidden inventory is real, the industrial demand is overstated, the recession that everyone fears finally hits, factories shut down, and the demand for silver collapses. The 4.2 million ounce drain we just saw was just a one-off anomaly. In that scenario, silver goes back to being a dead rock. In Path 2, the inflationary squeeze. The hidden inventory is encumbered or non-existent, the industrial demand is real and inelastic, the COMEX vault drain continues until it hits a functional zero, where there is literally no metal available for delivery. In that second scenario, you don't get a gradual price rise, you get a gap up. A gap up is when the market closes at $81 on Friday and opens at $110 on Monday. It happens when the sellers simply disappear, when nobody is willing to trade paper for metal. The 4.2 million ounce drain we just saw is the strongest evidence yet that we are on Path 2. Why? Because of who's taking the metal.
It isn't speculators. Speculators buy futures. Speculators buy options. Speculators don't take delivery of 1,000-ounce bars that require armored transport and secure storage. That is a logistical nightmare. You only do that if you need the metal for a factory or if you are a sovereign entity that doesn't trust the dollar. This was a strategic withdrawal. And that brings us to the final piece of the puzzle, the playbook. If we are right, if this is the beginning of the end for the fractional reserve silver market, how does it actually play out over the next 6 weeks? Because it's not going to be a straight line. In fact, the next move might be down. The institutions that are short this market are cornered, and a cornered animal is dangerous. They have one weapon left, the paper smash. They can print infinite paper contracts. They can sell 1 billion ounces of digital silver in a nanosecond to drive the algorithm price down. They will try to break the technical support. They will try to make the chart look so ugly that you sell your position in disgust. But here's the difference this time. Every time they smash the paper price, the physical drain accelerates. If they push the price down to $75, the arbitrage with China gets wider. The industrial buyers say, "Great, a discount," and they buy more. So the lower they push the price, the faster the vault empties. They're in a trap, a mathematical trap. In the 4.2 million ounce drain was the sound of the trap snapping shut. So, what do? You don't panic buy. You don't leverage up. You watch the one indicator that tells the truth, not the price, the inventory. I'm watching 3 specific numbers next week. If these numbers hit, the game is effectively over.
The first is that 80 million ounce floor and registered. If we breach that, the psychological dam breaks. But ultimately, this comes down to a simple binary question I want you to answer below. Not with hope, not with silver to the moon slogans, but with logic. When the paper price says the metal is abundant, but the physical vault says it's vanishing, which one is lying? If you think the industrial panic is temporary, then $81 is a gift to sell. But if you think that 4.2 million ounce drain was just the opening salvo of a much larger delivery failure, then $81 is the mispricing of the decade. I'm not here to tell you which it is. I'm here to show you that the exit doors are being welded shut while the theater is still selling tickets. Next time, I'm going to show you a document from the Shanghai Gold Exchange that hit my desk this morning. It details a specific change in their import quotas for March that directly contradicts the narrative coming out of London. It's technical, but it explains why the drain is accelerating right now. Watch the flows, not the ticker. I'll see you then.